Hello everyone, welcome to this week's podcast. This week we continue our discussion of trade, but we move on to talk about how countries can serve to protect themselves from unfair trade practices, as well as what legitimate protections a country may place on domestic markets to protect domestic industry. Now, as a country seeks to liberalize trade markets through the application of the various principles we've discussed, such as non-discrimination, most favored nation status, and the elimination of all trade quotas, it must also preserve ways to protect its domestic markets. Indeed, sometimes trade, be it deemed fair or unfair, may have negative effects on the importing country's market. International law has developed over time to try to limit the effects of certain of these practices that it is deemed unfair, and to grant countries as a result certain limited rights to protect their markets. For example, producers in one country that sell excess products at below production cost levels in another country are doing what is called dumping. That's a term under international law. It's thought to be a predatory practice because domestic producers find it difficult to compete because the prices are artificially low. Let me try and illustrate this using an example. Let's say we have two factories, one in the United States and one in China, and both are producing solar panels to sell in the US market. Now, if the Chinese competitor starts to sell its goods at a 30% less than the cost of our domestic producer, it's going to drive our domestic producers out of business, and they're not going to be so happy. So what can our domestic producer do? Well, if he thinks the Chinese subsidy is illegal, is an unfair trade advantage, our domestic producer can go to the US government to complain. In the United States, complaints are filed with the US International Trade Commission, ITC, and the Department of Commerce. Both of those organizations play a role in resolving the disputes. If, after an investigation, the government determines that yes, they agree that dumping is occurring and is causing harm to domestic industries, then the state is authorized to take measures to protect the domestic industry. It does so by imposing a duty or tax at the time of importation. So, if our Chinese competitor ships to the United States, the solar panels will be stopped at the border by our customs patrols. Once they are stopped, a duty will be imposed of an additional 30% to counteract the effects of the dumping and allow the domestic producers a chance to compete. Now, the duty is only designed to level the playing field and allow competition. It's not designed to put the American firms in a better position than the foreign firms. Now, another trade practice that is often scrutinized is the use of government subsidies. Governments, including the largest economies such as the US, the EU, and certainly China, spend billions of dollars each year subsidizing certain industries, including farm, aerospace, clothing. And it's not always the small companies in need of help that get these subsidies. Indeed, Boeing, a major manufacturer of aircraft, received over $13 billion in subsidies from the US government in recent years. Now, this isn't to say that all subsidies are unfair. Some types of subsidies are allowed under the trade rules, and some are prohibited. Subsidies that require recipients to meet certain export targets or to use domestic goods instead of imported goods are prohibited because they are specifically designed to distort international trade and therefore are likely to hurt the market in the importing country. Now, other subsidies, which are termed actionable subsidies, it really matters what the effects on the domestic market. If the subsidy is harming the domestic market, if the company or the country can show that the subsidy has an adverse effect on its interest, then the subsidy may be prohibited. So what can the country use to show adverse effects? Well, it can demonstrate harm in three ways. One, it can demonstrate that the harm hurts a domestic industry. The domestic industry is unable to compete, therefore is being harmed. You can also demonstrate that the subsidy hurts rival exporters to your importing country. So because goods can be produced cheaper due to government subsidies, other exporters into the country find it harder to compete. And finally, you can show that the subsidy hurts rival exporters to the subsidizing country. So if China has a subsidy to allow for the development of solar panels, it may be difficult for exporters from countries like the United States to export to China because their producers are receiving such subsidies. So you can demonstrate harm based on any of these three categories. Now, if there is no demonstrable harm that's resulting from a subsidy, then the subsidy is permitted under international law. Thus, where trade materially injures a domestic market, the rules of GATT allow countries to protect those markets using things such as safeguards, escape clauses, and as we just discussed, anti-dumping duties. Now, the protections are enforced through the customs of various customs organizations of various countries. In the United States, it's called the U.S. Customs and Border Protection. Every product that comes into a country must pass through customs anytime it crosses an international border. Now, typically, this involves a three-stage process. 1, the goods must be identified and country of origin must be determined. 2, the goods must be valued. And 3, the tariffs or duties are collected. Now, many of these processes are harmonized among WTO members through the use of a harmonization schedule under the Customs Valuation Code. So a lot of this will be very similar depending on what country you are importing or exporting to, but I'm going to give an example of the United States. So let's bring in our businessmen and we'll answer a question: how do you determine the potential duty applicable to a particular good? So our businessman here is wondering what to do, and then he has an idea and he decides he's going to import coffee from Ethiopia, a country known for its flavorful Arabica beans. So our hero is feeling pretty good about his idea. He locates a plantation, signs a contract, and hires shipping. But there's one more step. He needs to determine how much duty he may or may not have to pay when he imports his goods into the United States. It's a cost of doing business internationally, and if you're going to do business internationally, you must plan for the costs of importation. So now how does he figure out what to do or how much duty he'll have to pay? Well, the first way is to get a binding ruling from the Borders Patrol. Now this can take some time. It's not always the best bet, but if you submit enough application, the Customs and Borders Patrol will give you a document that says here's the amount of duty that would be required for that particular good. But that takes time, so maybe you rather just hire a particular classification specialist. There are companies and firms that have grown up in the new international trading regime that have specialties in identifying the types of products you're importing and the duties associated on those products. And finally, the cheapest way is just to do a little bit of research yourself. Now, it is important to stop here and say that the actual duty that will be imposed upon your goods will be determined by Customs and Border Protection at the time that the goods are imported. So if you're doing research on your own or hiring a company, largely what you're going to get is an estimate of what the likely duty charges will be. If you get all the information, if you get all the classification information, you provide all that and you do your proper searches, it's a good estimate. But the only way to get a certainty with respect to importation costs would be through a binding ruling. Now let's go on and complete our example here. So what we're going to do here is we're going to go to the website for the United States, the Harmonized Trade Schedule. And our man wants to import coffee, so we're going to type coffee into the search engine. You see on the left-hand side we have a column that lists coffee. There's its heading 0901 and various subheadings listing the different types of coffee. You can also see this reflected over here in this column. So we have our general coffee category. We have different types now. We have not roasted or roasted, decaffeinated, Arabica, other decaffeinated, various organic levels. Now our rates of duty are determined by these columns over here. We have two columns, 1 and 2. Column 1 is under general, is the amount charged to all nations under the WTO who are in normal trade relations with the United States. Special is those charged to countries that have special trade agreements like NAFTA. And the second column over there is information about countries that we don't have normalized trade relations with. Right now that's only Cuba and North Korea. Given sanctions on those countries, it's very hard to do any trade with them. So we see here that coffee is actually free from tariffs. There are no tariffs associated with the importation of coffee. Now if our person here was importing something like crushed or ground paprika, we could see that there's a 3 cents per kilogram charge for countries that have normalized trade relations. There is a free for countries that have specific free trade agreements with the US. They're listed here. And then if you're in one of the countries that don't have normalized trade relations, you see there's an even higher tariff importation tax. Now, tariffs can be calculated ad valorem, which means as a percentage of the total value of the goods being imported, or they can be specific, and that's what we saw with paprika there. That's a certain set price per weight of good is usually how they do it. Now, if it is going to be ad valorem, you ask, how do I determine the value of a particular good? Well, you do that through a number of different methods. The most common is to use simply the transaction value. How much is the value of the goods under the current transaction? That'll determine the duty. Now, if that isn't you can't determine that, you might look to identical goods from the identical shipper being sent to the same country. And if you can't do that, maybe you look to similar goods. But transaction value is the primary way to determine value. If you can't determine transaction value, you may use what's called the deductive value. The deductive value is determined on the basis of a price at which the imported goods or identical or similar goods are sold to an unrelated buyer in the greatest aggregate quantity. So the largest amount of goods sold, you take a unit price and figure out what the value is of your particular order. After deductive value, we have computed value, which is very difficult to use and as a result is rarely used. It determines customs value based on the basis of the cost of the production of the goods being valued, plus a certain estimated amount of profit and general expenses reflected in sales from the country of exportation to the country of importation. So it basically tries to get a sense of how much money you're going to make on this, and we're going to talk about value in terms of all cost of production and likely profits. And finally, the final way you can do it is through what's called a derived value. This is basically using any other reasonable method or means at your disposal. It is the fallback method that is only to be used if the other methods cannot be used. So once you classify the goods, you determine its value. That's how you can then determine how much tariffs will be charged. Now, just as countries control the import of goods, they also control the export of goods from their country. Whereas the former primarily focuses on the protection of domestic industry, and sometimes the health, safety, and morals of the citizen, export controls typically focus on preventing certain technologies, such as weapons, from falling into enemy hands. There are national security issues with many such products, including products that are what are called dual use. Those are products that have civilian and military applications. You could also use export controls when your country has been responsible for developing new technologies. A country may try to keep a competitive edge even if it is not used in a military application. And then sometimes a country may have export controls to protect scarce or important resources, protect domestic markets from shortages if they're vulnerable. All right, well, that's it for this week's short podcast. Remember, the midterm is this week. Read the lecture book and the chapters. The questions in the midterm are largely prepared by those who wrote the book, so pay close attention to the book. There are no other assignments this week, so good luck on the exam. And if you have questions, don't hesitate to get in touch with me, and we'll see you on the discussion board.